Welcome back. It's Jason Walter here, and here's your latest housing market update. But in today's video, I want to touch on what's happening right now regarding mortgage rates, because there's a lot of talk regarding how high they are right now. So the current levels we have today are more or less the highest levels going back to December of 2000, which is absolutely insane, excluding 2 days yesterday. So I want to share how this is really destroying home buying demand, and I'll share some data on that. But I'm also going to share how this is destroying the supply side as well. We have a low level of homes for sale of existing houses, and of course home buying demand is very low as well. I'll share some stats regarding each of those here in today's video. And before we get started, I invite you guys to subscribe to this channel right now, because I post frequent housing market updates so you guys can make a more informed decision about whether to buy or sell a house based on the latest data we have today. So I have a lot to share. Let's begin today's video. This report here covers rates as of Friday, the last business day here. The average rate as of August 25th for a 30-year fix for people with great credit, according to Investopedia.com, was 7.67%. Absolutely crazy. On nearly 8%, which is just crazy. Also, according to the Mortgage News Daily, again, for people with exceptional credit, putting at least 20% down or have a loan to value ratio of at least 80%, the rate is at 7.39% as of last Friday, nearly a 23-year low going back to December of 2000, because here is rates over the past 1 year, which is right here, 7.39%. Besides 2 days last week when rates were around 7.48% and 7.49%, the highest rates going back to December of 2000 when looking at daily rates. Also, the daily rate 1 year ago was at 5.81%, an increase of nearly 1.6 percentage points over the past 1 year here. So in today's video, I want to touch on the demand side first, and then we'll talk about the supply side. So here's how rise in rates is really impacting demand right now. So 2 years ago, back in July 2021, based on the most recent data we have based on the median sold price back then, according to the National Association of Realtors, was $365,000. Assuming putting 5% down at the rate 2 years ago, back in August 2021, was very close to all-time record lows. Technically, the all-time record low was set back in January of 2021, but at 2.9%, that was very, very close to all-time record lows. So looking at that, for someone buying a median price home 2 years ago at 2.9%, your housing payment of principal and interest would be $1,443 per month. Now, fast forward today at daily rates at 7.39%. The median sold price as of July 2023, according to NAR, was $407,000. Putting 5% down, your new housing payment would be $2,674 per month. And by my calculation here, that's an increase of $1,231 more per month to buy a median price home today compared to just 2 years ago. That's a giant increase of 85%. So that's number one. Your housing payment to buy an average price home today compared to 2 years ago just went up by about 85%. Can you say not sustainable? On top of that, because rates increased from 2.9 to around 7.4%, that's an increase of 4.5 percentage points, or that means your buyer's purchasing power just decreased by 45%. So not only are your average payments increasing by, 85%, but your buyer's purchasing power also decreased by 45%. And because we're seeing a rise in home prices and also rates, housing affordability is at all-time record lows based on my own analysis of NAR's data. I shared this in a previous video though, but housing affordability right now is at the lowest levels on record going back to at least January of 1989. So housing affordability is an all-time record low at about a 3-decade low, according to the latest trends we have from the National Association of Realtors. So of course, because housing affordability is at all-time record highs and we're seeing a giant increase in your average monthly housing payment, Of course, it makes sense we're seeing fewer transactions as well, because here's a look at the number of pending home sales going back to March of 2012. I tend to talk about the changes in contracts being signed, which is a pending home sale, going back over the previous 3 years. But I actually found a really good chart here from Redfin going back over the past, 11 years here. So the current sales pace, or the current pace of contracts being signed between buyers and sellers of existing houses when looking at pre-pandemic levels, is roughly on par with the lowest levels going back to approximately 2014 and 2015. So in other words, we're seeing the fewest amount of contracts being signed when looking at pre-pandemic levels in about 8 years. So of course, part of the reason why we're seeing a decrease of pendings is because of this huge increase in prices and of course rates as well. And of course that caused housing affordability to be at all-time record lows. But on top of that, we're also seeing a huge decrease in the number of houses for sale. So that is on the supply side. So actually rates being at more or less 7.5% right now is also impacting the number of people who are actually selling their houses right now. And that's impacting the amount of houses actually for sale, or housing inventory, or housing supply. So according to the most recent trends we have, according to Realtor.com, which is for the month of July, there was around 650,000 homes for sale. Going back to July of 2019, approximately 1.2 million. July 2018, nearly 1.3 million. In July 2017, just over 1.3. And then in July 2016, nearly 1.5 million houses for sale. So what does this mean? This means we have approximately 57% fewer homes for sale nationwide compared to July of 2016. On top of that, we have approximately 50% fewer compared to 2017 through 2019. But wait, check this out, because I found this on Redfin's website as well. Here's a look at the number of houses for sale according to Redfin going back to March of 2012. So according to them, we have right now around 1.1 million homes for sale. I don't know why Redfin has a much higher number of homes for sale compared to Realtor.com or AltosResearch.com. At 1.1 million, this is roughly on par with the National Association of Realtors as well. In any case, so the number really doesn't matter so much. The difference between pre-pandemic levels and in years past really does, though. And that's why I want to share this. So at 1.1 million, according to Redfin, this is much lower compared to pre-COVID levels back in 2019 when we had over 2 million. Also looking at in March of 2012, there was nearly 3 million homes for sale. Now there's only 1.1 million. I should correct myself because I actually just looked it up. Redfin noted for the month of July, we have approximately 1.3 million homes for sale seasonally adjusted. In any case, at 1.3 million, we can all agree that we currently have far fewer homes for sale compared to 2012, when there was nearly 3 million homes for sale. In fact, when we zoom out going back to January 1999, it's actually worse though. So here's a look at inventory levels according to NAR that I found on calculatedriskblog.com. They actually have a look at inventory levels according to the National Association of Realtors here, going back to January 1999. And again, NAR is reporting inventory at around 1.1 million houses for sale right now. And in fact, don't take my word for it. Take a look at this, because according to our good Uncle Fred here, there's 1,110,000 houses for sale as of the end of July, according to the National Association of Realtors here. So going back to this chart here, at 1.1 million, this is much lower compared to, let's just talk about the right before the onset of the Great Recession here. Because back in, let's just call it 2004 through 2005, there was around 2 to 2.5 million homes for sale. Now there's only 1.1 million. Additionally, from January 2013 through January 2016, we had around 1.7 to around 1.25 million homes for sale, far below current levels we have right now. Also, something you guys should be aware of as well, right before the onset of COVID, we had very low levels of the amount of houses for sale. So back in January 2020, which is right here, more or less the lowest levels of houses in at least the last 20 plus years. And of course, COVID hit, rates decreased to about 3%. That actually caused home buying demand to increase greatly. And that's why we saw inventory fall out in 2021 and also in 2022 during the spring months. Big picture here, we're seeing a lack of demand right now because there's a giant increase in rates, nearly the highest rates going back to December 2000. And of course, we have all-time record lows for housing affordability, which, by the way, this article right here from NAR only goes through June. And back in June, obviously rates were much lower then than they are now. So once they announce this report here for July, we're gonna get to a new all-time record low as well. So big picture, what we're seeing right now is the lack of supply as seen by the huge decrease of contracts being signed, and also due to the fact we have a huge decrease of housing affordability, the lowest levels going back to at least January 1999. So a huge pullback in demand, but also because rates have increased to nearly 7.5%, we're also seeing huge pullback in supply. So we're seeing a decrease in demand and also a decrease in supply. What I'm personally looking at though is that we're going to see inventory levels peak later this year. Inventory levels tend to peak in the summer months, but in my personal opinion, again, if I had to put my real estate market fortune teller hat on, I would imagine we're going to see inventory peak later than normal. Inventory peaks in around August and July each and every year. I would imagine that inventory levels is going to peak in September or October this year because we're going to see a huge pullback in demand, and we're not going to see a huge increase in supply or new listings, but we are going to see a huge decrease of home buying demand, and that actually is going to cause inventory levels to increase. Just like we saw last year. Remember, last year we saw a huge pullback of new listings, yet inventory levels were increasing greatly, right? So we're going to see that yet again, in my personal opinions. We're going to see inventory continue to increase on a national level. Of course, every real estate market's different though. But that's just my personal opinion about what we're going to see regarding our housing market. And when inventory levels increase, that should impact home prices, but not the same decrease we saw last year. So keep in mind, inventory levels were absolutely skyrocketing at this time last year, whereas this year, inventory levels are relatively flat compared to the start of the year. So at 1.1 million, to start the year, we're at 980,000. A small increase compared to the start this year versus a giant increase of supply that we saw last year this time. But please leave me a comment below with your real estate market predictions. I actually love reading your predictions, even though if they differ compared to mine, it's okay. I like to have varying opinions regarding what's happening in our market here. In any case, thank you so much for watching today's video. I appreciate you, and we'll see you on the next video.